Hi, this is Stephen here from Navigator, and today we're going to do a masterclass on how to implement a repair strategy on Twitter. So let's talk about an original trade we placed back on the 28th of April. Today is August the 20th, around that date. We sold the May 15th short strangle at the $42.60 strike. So what that meant was we wanted Twitter to trade between $42 and $60. We received 81 cents in share premium. And our break even for that trade was if Twitter traded above $41.19 and below $60.83. At the time of placing the trade, the share price of Twitter was at $51, and we had over an 80% chance of success. Unfortunately, the earnings report was terrible. The share price of Twitter fell to $40, and it continues to fall. We've implemented a number of strategies over the months to bring our break even down, so we have it down to $39.85. But we now have a new target price in the stock, which is $34, and we have that target price right up to the end of the year. The share price at the moment, with the current correction in the markets, is at $25. So our current loss per share is significant. It's at $14.85 per share. So we need to implement this repair strategy to try and exit the stock at $34 by the end of the year. If we implement this and this repair strategy works out, we're actually going to escape this trade with a loss of just 32 cents per share. And that's something I would absolutely take right now if you were to hand it to me now. So we'll move on and show you what we're talking about. Well, we've got control over a certain amount of stock at the moment. So what we're going to do is buy control over the same amount in call options. So effectively, we're doubling up our stock position without actually purchasing more stock. And we're going to buy the $28 call options on Twitter, and we've paid $2.71 for those for the December 18th expiry. Now, because we effectively have control over twice as many shares, we can also now sell covered calls on those particular positions. And we're going to sell at our target price of $34. And the premium we're receiving for that is $1.12. So effectively, this trade is only going to cost us about 47 cents per share, and we'll explain that later on in our spreadsheet. So what are the benefits of doing this strategy? Well, the trade is only costing us 47 cents. This is because the sale of the $28 calls is offsetting most of the cost of the $34 calls. Again, we'll talk to you about that in the spreadsheet in a little bit. If we do nothing right now and the share price does recover to $34, we will be in a loss position of $5.85 per share. That's because our current break even is $39.85. So the repair strategy reduces our loss to 32 cents per share for the exact same outcome. So it doesn't make sense not to place this particular trade. It also improves our chances of getting out of the trade in the shorter term. What is the downside? Well, there is a cost to this trade. It's at 47 cents, but we feel that that's a cost that we're willing to take because of the potential of getting out of the shares at our new target price. The strategy does not protect you against further declines in the share price of Twitter. If the share price does recover fully to $40, we do not benefit from that either. So if the shares do rally from here, you're not going to benefit from that particular outcome. So there are some of the downsides to these particular strategies. But having said that, our new target price is 34. We'd sell out of that trade anyway at that price, so we may as well implement this strategy. I'm going to take you through the numbers now in an Excel spreadsheet. So let's run through the numbers here in this Twitter trade. As I said earlier, our break even here is at $39.85, our new target price at $34. So as we said, we want to try and get out by the end of the year at $34 if we can on Twitter. We believe the stock will recover at some stage. So we're going to buy the $28 calls expiring in December, and then we're going to sell the $34 calls expiring in December. So what we've done here is we've set up a what if scenario here. So what if the share price was at $28 in December? What if it was at 30? What if it was at 32, 34, etc.? So we start plugging in the numbers we know. Well, we know we bought the shares of Twitter, or our effective break even now is at $39.85. We're going to purchase the $28 call options. That's costing us $2.71. Again, that's the same for every particular outcome here. We've paid for the calls what we've paid for them. And then you're going to see two entries here. One is sold call options, and we've repeated that again. And we sold the $34 call options, and the reason we've entered it twice is because we're selling call options on our stock position, and we're also selling call options on our $28 call position. and we received 112 in income from both of those. So that's income that's coming into us, and that again is the same for every particular outcome. So now what we have here, that's a mistake here, I'm going to change that right now. So we need to assess, well, what would the value be of these calls in December if the share price, for example, was at $28? Well, the answer is 0 here for the $28 calls, because call options only have real value or intrinsic value in them when the share price is trading above the strike price of the call. So the strike price is 28. We're saying here, well, what if the share price was at 28 in December? Well, then there's no value in that call option. If the share price is at 30, there will be $2 of value in that call option. At 32, there will be $4, and so on and so forth. Then we get down to our short calls. Remember, we've sold calls as well. And again, we've two entries here, because remember, we sold the $34 calls on our stock position and also on our call option position, our long $28 call option position. And again, we have to put a value on them. We're assuming now we're at expiry Friday in December. It's the 18th of December. There's no time value left on the options. There's only real value left in them. So at this stage, we have to get right up to $36 before we see any value in these particular calls. So remember, there's only value in call options when the share price is trading above the strike price. The strike price of our short calls was 34. We're saying if the share price is at 36, there's $2 of value in those calls. Now the reason we've put in -2 here and not +2 is because we sold those call options. We don't own them. So that's a negative situation for us. Okay, but that's more than offset by the positive situation in our long calls and in our long stock. Again, we've done that for the same one down here below on our call option position, and we've done it for every potential outcome. So you can see here, when we add up all the columns here, if the share price is at $28 in December, we're still going to be in a loss position of $12.32 per share. But if we get to 34, we're only going to be in a loss position here, 32 cents per share. And you will notice that for every single situation above that, our loss position is capped at 32 cents. It doesn't improve from there. And the reason is we've effectively agreed to hand over control of our shares that we have control over at $34. So even if the shares shot up to 50, we would only be able to hand them over to some people at 34. But that's a position we'd happily take right now. Okay, this is Stephen here from Share Navigator. We hope you get some benefit out of learning from these repair strategies. Thanks and bye for now.